Wall Street is coming after Main Street, right smack at this single family housing. It's going to be an interesting time to watch. I can tell you one thing I learned: it's never going to stop. So you have to figure out a way to be outside of that system and participate in it, because you're not going to stop it.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Many of the recent housing analysts I've talked with, like in last week's excellent interview with mortgage expert Melody Wright, see tougher times ahead for the real estate market. So for further context, I thought it would be helpful to get a true boots on the ground view from one of America's more successful property investors. What's he seeing across the thousands of property units in his portfolio? Is he buying, selling, or holding steady given current market conditions? And where does he see the housing market heading from here? For answers, we turn to Ken McElroy, founder and CEO of real estate investment and property management firm MC Companies. Kenny, thanks so much for joining us today.
No problem. Always good to see you, Adam.
Kenny, it's always great to see you. We've known each other,
A long
for
time.
at least over a decade here. We've had some pretty fun adventures. It's been a while since I've seen you, so it's so fun to have you now come on Thoughtful Money, and congrats with all the success that you've had, not just in your investing career, which we're going to get into, but with your YouTube channel as well. And we'll tell folks where to go to watch that. But anyways, thanks so much for coming on. This is going to be a lot of fun.
Yeah, for sure. Let's enjoy this.
Okay. Well, look, I like to start these conversations off with an intentionally broad question. So let me ask this of you, tweaked to your area of expertise. What's your current assessment of the U.S. housing market?
Well, it's the kind of the tale of two different cities. So, you've got the single family market, which is what the majority of people are in, and that's what kind of hits the news. And then you have the commercial market, which is dramatically different. And then in the commercial market, you've got, of course, office doing one thing, multifamily doing another, self-storage, warehouse, commercial retail. They're all being pulled in different ways. So when people sometimes lump the real estate market, I always have to ask, like, which one, you know what I mean? And I can talk about all of them because, at this point, as you know, Adam, we've done a little over 3 billion in transactions. We currently own 2 billion in real estate assets, and we've been in most of those categories over that period of time. Our company's 24 years old now. We have 300 employees, and so we've learned a few lessons along the way, and we watch all the sectors.
Great. All right. Well, if you don't mind, maybe let's just dial through them all, at least quickly, and just give a quick assessment of what's doing well and maybe what's not doing so hot.
Sure. So right now we're focusing on multifamily. So I own about 10,000 apartments across mostly the Western U.S. And so what happened was when the Fed started raising rates, let's call it a year and a half ago, so many things changed. So the first thing that changed, which is going to be more of a lag effect, is going to be that people that were building pulled back. So that's also home builders and multifamily builders or anybody else that's building anything, because the cost of money went up a lot. And in a short period of time, as those 3/4 bumps, each time were significant, especially when we're used to a quarter here, a quarter there. So what happened was construction debt, as an example, went from, let's say, 4% to, over 9%. And so when your cost of money goes up, you pull back and you go, wow, this deal doesn't make sense financially right now. So I'm just going to put this one on the shelf and kind of finish what we have. And we'll kind of circle back on that later, because what that did and what that's going to do is it closed everything down. And so what we have is we have a potential supply problem that's about a 2 to 3 year lag. So that's one thing, and that's both on multifamily and single family. And then, however, the higher rates are making people not refinance and not sell, because they refinance that whole refinance market on the single family side. People are sitting there at 3% and 4% mortgages. The last thing they're going to do is trade those out, at twice the amount. So they can't even move laterally in the same neighborhood. They can't move to the house next door that might be exactly the same, but because the rate is so much higher. So so they're staying put. So that's created a real problem with listings. And so we have a supply problem there. And so what we have is we have this lag of supply on in both sectors. And that's really one of the bigger things, dragging that side of the equation.
All right, Kenny. So I want to talk about that lag effect in supply. And thank you so much for mentioning the lag effect, because it's something I talk a lot about in this channel. And I get some understandable pushback on it because, we have stocks still near all-time highs. We have home prices still near all-time highs. So people are saying, you keep talking about this lag effect, but I'm not seeing, prices come down. So is it really going to matter this time, right? And, lag effects by definition act with a with a lag. And there have been a lot of things going on that have, I think, delayed the arrival of the lag effect in large parts of the economy because there's been so much additional liquidity being pumped in. But when it comes to supply, you said that, kind of one of the themes you see going forward is because the cost of debt went up so much, the builders of a lot of these projects said, hey, the projects that I was going to do isn't going to pencil out, and so I'm just not going to do it for right now, right? So
Yep.
I think you at some point expect to see a supply shortage from that. But in the here and now, there was a ton of development while the market was
Yep.
hot, right? That didn't end until relatively recently, right? Like maybe 2-ish years ago or so. So isn't there still an ongoing lag effect of all those pipeline projects still hitting the market? Like, is supply going to be increasing here for a while, in both commercial slash multifamily and perhaps even single family homes in the popular hot markets?
No question. Yeah. So here's how I'll just, we have 7 projects under construction. Here's how they work. In 2020, we're doing all the pre-development work. Then you get a permit. And then 2021, you go to the bank and you get the loan and you start building. Well, the 2021 project, it's at least a year to a year and a half to build it, and then at least another half a year to a year to finish it. So if I'm going to build a 300 unit apartment project, it's a 3 year ordeal from the time you break ground with a shovel. So that's the lag there. And then, of course, during that period of time, we had rising interest rates and rising costs. Don't forget about that.
Yeah.
We also had inflation. So the cost of a microwave, the cost of a washer and dryer, the cost of a stove, the cost of stucco, concrete, framing, all that stuff went up. And so not only did the interest rate costs go up, but the cost to actually construct it went up. So, if you're in the business like we are, you're like, okay, this is not what we thought it was going to be when we first pulled the loan out. And and so that's actually what people are dealing with today. And once you start, once you're pregnant, that's our our little term inside of our company. Once you're pregnant, you have to finish. You can't break ground on something and stop.
Right.
That
A half-built project has
Yeah,
no value to you, right? Yeah.
right. Yeah. So you have to finish. And so what, to your point, the lag is the lag of construction, the lag of all the costs, all the things that happen during that period of time. There's a lag. Then, of course, a vacant building is also not worth much, right? So then you have a lag of a lease up or a lag of, whatever it is, because the real estate doesn't work without people. And so you have the people part later. So you build if you build it, they will come, right? So you build it and then you have to fill it. And, that can be 3 to 4 years before anything's really stabilized in my world. And so, any projects that are hitting right now, Adam, we started in 2020, 2021. And then when the Fed started jacking the rates up, those are the ones that are next. So what you've got is you've got over 1 million units actually hitting the US right now. And many of those are going to spill into next year as well, hundreds of thousands more. But after that, it drops off just because, specifically because of the higher interest rates. And, as better than most, low rates create bubbles, and they create bubbles all over the place. They also create bubbles with construction.
Okay. And so you said it's about a a 3-year development cycle, at least for the bigger projects like yours, right? So we had, if you go back 3 years from now, right, we're in May of 2024. That was, first half of 2021. Real estate was really beginning to take off here. So I'm assuming that developers were just full bore, gung ho, let's build everything we can. Rates were still low, right? So money was still cheap to borrow. So there's probably a pretty big bolus. I mean, I overuse this terminology, but kind of a pretty big pig that we stuck in the python that's now traveling through time to us. We have this phenomenon, at least in the single family home market that you alluded to earlier, where transactions have really frozen up, right? But prices haven't come down yet. And because existing homeowners, as you said, it's not advantageous to them to sell and then buy because they largely couldn't even, they'd get a worse deal if they were even buying a home just like they're in right now. So they're all trying to wait this through. The problem is that more and more supply is going to be coming on the market, at least in these hotter markets, right? Like the Austins and Dallases and Nashvilles and Miamis of the world, where builders were building like crazy. And then, of course, that's single family homes. Then you have multifamily guys like you who also have projects that are coming into these markets that are adding additional units, right? So as those housing markets are cooling, more supply is probably only going to put more downward pressure on prices. And so the sellers that are trying to hold together in solidarity, time is not their friend here, at least not in the near term, I don't think. And I'd love to get your thoughts on that, because it seems that kind of what you're laying out for us is this period where demand is cooling, supply is coming onto the market. We're probably going to have oversupply, at least in a lot of the recently popular markets. It's probably going to be maybe a couple of bad years. But then, because builders now are not building new projects, maybe in 2026, 27, 28, we're going to see some sort of inventory tightening. So we'll have a market, I don't want to say crash, but a market correction, and then maybe setting ourselves up for a new cycle in the latter half of the 2020s.
There's no question. That's exactly right. And I think the way to really look at it, a lot of people, they also need to know that when somebody's going to build somewhere, let's say, where am I going to build? I would probably build right now in Austin or Dallas, as an example. So there's a fair amount of concentration there, or Phoenix, we'll just say, which is where I am now. So you're going to have, 30, 40,000 units being delivered this year in those markets, all three of them. And so what that does is it creates an imbalance. And this is good for the renter and really good for the renter, bad for the person that's building. And so, which, to be honest, the renters have, they've had a bad go at it. The last 5, 6, 7 years, rents have gone like this, and it hasn't been good, precisely because there's been an imbalance. So, when you look at, there's only really two things that drive housing. One is people and the other is inventory, right? Mm-hmm. So the supply is really, really important to make things affordable. I'm a huge fan. I believe people should rent first and then buy a home. That's the way I believe that is the right way to go. They build up their credit. If they want to stay in the rental, they can. But traditionally, they save money and they move to the home. That is actually severely disrupted the last few years because we've had this rent growth, and it was all based on the lag from the prior, from before when rates were even higher. So you start to take a look at anybody. People consume when rates are low. And that also is the same for a builder, same for a developer, same for a home builder. And so that's all hitting now. And, the consumer, the homeowner, there's going to be this call it a couple year period of time where it's going to be really, really very, very good for anybody that's going to be buying.
Okay, well, so let's hope so, because right now on the buying side, prices are still up near record levels of unaffordability, right? I remember seeing a stat, I'm trying to remember the name of the organization that put it out, I'm blanking at the moment, but it was a few months ago, and they looked at, I think it was the majority of counties across the country, and said, in the counties that we studied, in 99% of them, the median income owner couldn't afford the
Yeah.
median house, right? So it's just ridiculous how unaffordable housing's become. And then on the renting side, there was a survey recently done that said that 40% of today's renters believe they will never be able to afford a house. And that's up from 27% just 1 year ago.
Yep.
So to your point, it just shows that these, aspiring home buyers have been just getting taken out to the woodshed the past recent years.
Yeah, and what's really happening, I did a couple of videos on this. I I'm we're moving to what I would consider to be a renter nation. And if you take a look at the balance, so if you take a look, there's 131 million household formations right now, and the renter represents about 34% of that, or about 44 million people.
Mm-hmm.
The that has the in my belief, we have that could be in jeopardy. It could go to 43, 42, 41, 40. And or I'm sorry, the other way. It could
Yeah.
go from 66, 67, 68, 69, 70. um it's possible. It's just hard to believe, but we could be heading toward what would be that, because the people can't afford houses. And so when I'm looking at, one of the best things to watch is, what is the price of a mortgage with taxes and utilities and all that, versus what's the price to rent, the home ownership rate versus the renter rate. It has never been wider. And so that's not good. When it gets really, really wide, it pushes people to the renter side. And, I had a person on my show give me the greatest analogy. They said, because the traditionally 6 months housing supply is kind of the right number. If in the MLS, the multiple listing service, is about 6 months nationwide. So if that represents a full sink, right now we're sitting at about half full. So I'm talking about supply.
Mm-hmm.
So, and then if the faucet represents new inventory, it's just on a trickle. And if the drain represents sales, it's also on a trickle. And so the kitchen sink is just about half full. And it's precisely a supply problem, because the interest rates are so high that people have trapped equity. The irony is that they have equity in their homes, but they can't go get it because they can't refinance, and they don't want to go buy something and have a higher interest rate.
Okay. Now I'm fighting all the questions I want to ask that aren't in my prepared list here. One thing I want to put a pin in and get your opinion on in a minute is there was this recent news that Freddie Mac has just petitioned to enter the home equity loan market. So to your point about the trapped equity, I'm wondering if that's going to perhaps help with that at all. But more to the point you raised here, and this is so fascinating for you being the guest on this, because you're one of these big companies that's out there building these big multifamily projects. I talk a lot about the growing wealth divide in this country, and I know that that's something that you care a lot about too, Kenny. And I've kind of made the comment that America really does seem in danger of losing its status as a meritocracy and really becoming an aristocracy, meaning that your odds for being able to achieve the American dream, which I would define as sort of a solid middle class lifestyle or better, is now by far most dependent upon whether you were born to wealthy parents or not, right? And there have been so many factors lately in the housing market, which I think have been real headwinds for people trying to become a home owner and enjoy the benefits of home ownership. That I worry that your prediction there that we may become this renter nation, because look, you've got one, just the price of houses, right? So it's getting harder and harder to buy one unless you're wealthy. But then you have the whole investor infestation, if you will, and feel free to pick a better word if you like, but of the single family home market, right? Where you've had institutions now coming in and buying massive swaths of housing, even in the same, metro area. And you also had the explosion of the short-term rental market, right? Where, affluent homeowners are buying a whole bunch of extra houses that they can just rent out and flip. And all of a sudden, the available inventory to the aspiring buyer gets smaller and smaller. And of course, they're competing with deeper pocketed people for that inventory. What are your thoughts on that?
You nailed it perfectly. We in my lifetime, we've never. You literally could be competing and buying a home in a subdivision and be competing against BlackRock. Never in my lifetime, or Amazon, or any of these. Never in my lifetime has that been an issue. The other thing you could also be competing against is somebody who's trying to do an Airbnb that is trying to get $10,000-$20,000 of rental income out of it. So back in the day, it used to be that real people that were moving into a neighborhood, that you had a real neighborhood. Now it's very, very different. You've got short term, you have long term, you got Wall Street in there, and then of course you've got this whole swath of people looking to buy second places and renting them out by the night. And that the whole industry has just boomed, and that's actually made it worse for the single family home buyer.
Do you see the pendulum swing back at all? Do you think that we'll look back on this at 10, 20 years and say things are getting a little out of hand, and then we passed good legislation and we made things fair and protected this for the home buyer? Or do you see this as the camel's nose getting under the tent, where eventually just big money essentially owns all the shelter in the country and we're just all renting?
Well, it's funny. I went through the '08 crash, and that's actually when Wall Street tipped their toe in the water. I remember, all these banks were taking back all those assets, and if you remember, they were selling them off to Wall Street, and they didn't know how to manage them. And it was just it was a mess, actually.
Right. At fire sale prices, by the way.
Yes. Right. And so they're like, oh, this worked, and so they would just get some management. I have a ton of friends that got into that business and were managing for some of these big groups out of Wall Street, because they could buy them, but they didn't know how to run them. And, there are all kinds of issues. I believe that actually set this whole thing, the precedent moving forward. And they actually said, this is the category that we need to be going after. So I think that's here to stay. But I will also say there's all kinds of legislation out there about them trying to restrict that, and have hold periods and things like that, because it's super disruptive. On the Airbnb side, or the short-term side, let's say, that game is over. It's been over. If you look at Airbnb, they've grown year over year just as a company. But what happened, Adam, is that the supply of Airbnbs doubled during that period of time, because so Airbnb, believe it or not, is still growing. So if you read, Airbnb is growing year over year, that's all true. But the supply has also grown by a lot, because, again, going back to cheap money and low interest rates. So it's literally the equivalent of me, building 3 apartment projects, on 3 different corners and competing against each other. So there's just, the consumer has a lot more options. And so, the Airbnb stuff is in pretty big trouble right now, at the individual level, not necessarily Airbnb, the company.
So let me ask you this then. So you were talking earlier again about the lag effect of supply, and right now that lag effect is increasing supply hitting the market. You were mentioning that in the context of pipeline projects, but how about Airbnb? So to your point, I heard a stat that basically in the past 2.5 years, the amount of Airbnb supply, or inventory, houses that were being rented out through Airbnb, doubled, right? And that was largely kind of the armchair investor, right? Who during COVID, we saw all the TikTok videos of, hey, here's how you're going to become a passive income millionaire, right? You're gonna buy one of these houses on the cheap, because credit was cheap back then, right? And you're going to rent it out, and the checks are going to come in. So you get all these sort of first time, novice investors jumping into the game. And then here we are, right? cost of capital has gone way up. Um, the revenge travel boom from COVID opening up is now behind us. Consumers increasingly sign that they're struggling. So all of a sudden, many of these Airbnb listings are not renting nearly as much as these people were expecting. And so all of a sudden, this dream of this thing that I don't really have to give much attention to, that's going to be putting money into my pocket every day, I now have to give a lot more attention to it, and it's pulling money out of my pocket right now because it's not cash flowing. What's the danger of all those, or at least a healthy percentage of those new investors saying, well, this was a misadventure. Okay, let me just get rid of this thing. Just let me list it, put it on the market, sell it. Could there be a material enough influx of inventory from those disaffected Airbnb investors that could actually exacerbate the supply lag effect that you're expecting?
Without a doubt. Yeah. We're already starting to see it. I mean, the funny thing is you can go on to Zillow, just look for pictures with bunk beds. Yeah, I'm not kidding. Like my wife and I have we have fun with this. We go on there. This was a former Airbnb. They're hitting the market now, I talked to so many people that got into this space. I said, that should not be your plan A. It should be your plan C. At the very least, you should be able to break it down and rent it long term. It needs to cash flow. If you could cash flow it long term, the Airbnb or the short term should be your plan C. But most people bought them as their plan A,
Mm-hmm.
and the occupancies are down, rates are down in very specific markets. I live in Scottsdale, and it's pretty bad here because of the amount of people that did that. But of course, but you can go around the country in California, or certainly up and down in Florida and Texas. It's the same story.
Okay, so I mean, I imagine that this is going to put it's going to be one of the factors putting material downward pressure on prices for the next couple of years, because probably a lot of these struggling Airbnb, Johnny come lately investors, maybe they'll try to switch from a short-term rental to a long-term rental, right? Which is just going to increase the amount of rental inventory. And you
Yep.
mentioned all the rental projects that are coming on. So again, rents will be getting pushed down even further. And in theory, at least, housing is supposed to be a function of what you could rent it for, right? I mean, that's how they calculate it in the CPI, right? Homeowners equivalent rent,
Yep.
right?
Yep.
So, um, it'll either depress rental rates and therefore bring home prices down, or they're just going to say, forget it, forget the rentals at all. I'm just going to sell it, and it's going to be excess sale inventory, and that'll depress housing prices. So you're nodding
Yeah.
as I'm.
Yeah. I think a lot of it's going to depend on the individual circumstances of the person. Obviously, if you're sitting on a 4% rate and today it's 7, you're probably going to jam a renter in there, maybe have a negative cash flow scenario or whatever. But it's probably pretty hard to sell that house because the rates are significantly higher,
Yep.
but not always. It's just going to depend on the individual circumstance of each person. But luckily for them, the home prices have not crashed at the same time. So the irony is they still have probably their equity in there. It might be a negative cash flow because of all the costs, but you never know. And so, but some of them are definitely hitting. And I know some people that are walking from their equity and just trying to get out of them, and just try to stop that negative cash flow.
Well, okay. And again, I know you're more multifamily, and I do want to get to sort of some of your best practices for success in real estate investing, because it sounds like you think there's actually going to be a pretty good opportunity here over the next couple of years for real estate investors to get in at lower prices, i.e., better values, than planning for a resurgence at the late end of the decade. Um, but let me just ask if I can, where do you see prices in this single home family market going? And I know it's every market's national, so it's going to be felt differently in different places. But do you think the cohort that currently owns and is trying to sort of shelter through the pressures right now and keep prices relatively high, will they be able to make it, or do you think that the oncoming supply and other dynamics, some of which you've talked about, some of which maybe we haven't quite yet, are eventually going to start bringing those prices down? Because here's my opinion, housing prices are set at the margin, right? Your house is worth basically what the closest comparable just sold for, right? And yeah, if no transactions happen, you can keep prices where they are. But there will always be some amount of transactions that happen, right? There are deaths, there are divorces, there are forced job moves, moves for a job, stuff like that. So there is an organic, at least trickle of transactions that still has to happen. And as more and more inventory comes on, and God forbid, if there's some additional injury economically, like maybe a recession at some point over the next year or two, that's going to make it, I think, really hard to continue to defend today's prices. But I'm not a real estate expert. You are. What do you think?
Yeah, so I've been through a few cycles. I've been doing this since the '80s. I will tell you, there's also one other factor that I know you're very aware of, and that is the migration patterns that happen, post COVID,
Mhm.
and that's very significant. So it's definitely worth mentioning. So, and I'm from Seattle. I've had projects in Portland, so I'll just pick on those two. I know you're from the Bay Area, so um,
Pick on that
just
all you want.
look at those three. I mean, literally, look what's going on there. And so why is that important? It's just important because people vote with their pocketbooks. Yeah, they're moving. And so I study things like out of state driver's licenses that are turned into Arizona or to Texas. That's a significant data point. One way Ryder truck, one way U-Haul, one way North American Van Lines, and there's a number of other things that you can track to see where people are going. So the reason I just bring that up is because real estate only works if there's people. So when somebody leaves, when I'm going to just say downtown Portland, when a lot of people leave downtown Portland for all the reasons that they want to leave downtown Portland, they're actually going somewhere. It could be the suburbs. It could be 30 minutes away. They might not leave Oregon, but the point is that all that what that does is it makes problems in some areas and then creates supply problems in others and demand problems in others. So and I'll just use Phoenix as an example. So what happened was we've had a lot of people move to this market. And so what does that do? It puts pressure on the schools. It puts pressure on the restaurants. It puts pressure on the single family housing. It puts pressure on the rental housing. So, and then conversely, when they move out of an area, it does the opposite. So I think migration is an important piece of, what's going to go on in all of these areas. And so there are definitely markets that are really, really tight. And oddly enough, so it depends on, which hat I want to wear. If home prices are going like this and they're going up, I actually want to buy rentals in those markets because, what I want a big disparity between the mortgage and the rent. That's what I want as a landlord. So it just depends on what hat you're looking at. Now, there's also areas where there's a lot of, let's say, rentals. And that's going to create softness and it's going to be an area that's going to be tougher for a landlord. So you have to look at the kind of the whole picture. But generally, to answer your question, just nationally, I would say I don't think that the supply that's hitting is going to significantly affect the price of single family homes. But it's definitely going to affect the rental market. So oddly enough, I think the single family home market is probably not going to move that much, but in some areas it will. But the rental market is actually going to get kind of slaughtered because there's all kinds of multifamily stuff opening and leasing up and adding supply in markets. But the irony, Adam, is that there's also people that would have normally bought a house that are now renting. So
Mhm.
just like in '08, so what happened in '08, if you really, really want to take a microscope and take a look, when people fell out of single family housing, they went into rentals. That's actually what created the rent run. You look at again going back, if somebody loses a home, they're not buying another home. They're moving to a rental somewhere. That could be a rental house. It could be an apartment. And that's precisely what fixed the rental market was all those people that had homes. And then of course the occupancies went up, the rents went up, and so this rent run went up. And then we had these low interest rates, which just put fuel on the fire. And then it started to run even more. That's starting to reverse itself right now.
Hmm, fascinating. Okay. Gosh, so many different questions here. I'm just going to go to this one. This one's a little it's a little out there, but just go with me if you will. Um, so I've heard you say in a number of the videos on your channel that demographics, play a huge role in the future of markets, and you really have to keep your eye on them. Um, I just love to get your quick thoughts on this question. I've asked a few other housing analysts before. Right now we're still at the tail end of that movement where every day 10,000 baby boomers hit retirement age, right? Um, and a lot of the home ownership and housing wealth, and frankly total net worth in this country is definitely quite skewed to the baby boomer generation. Um, uh, we're not that far away, maybe 10, 15 years from when that stat becomes 10,000 baby boomers are heading off, to a nursing home or sadly dying. Um, and that's going to last for about 15, 20 years. Demographically, if you look ahead a decade or more, what's that going to do to the housing market, do you think? Is that going to be like a permanent dampening effect on prices for a long period of time?
Yeah, so great question, by the way. I love this one because, well, you talk a lot about the pig through the python. Okay,
Yeah.
so I look at the baby boomers moving. So what can I do? Because it's happening. It's math. Um, well, I'm starting to buy 55 and older apartment complexes, and we're starting to dabble into the assisted care facility, and after that it's the full care, right? So if you just look at where things are right now, they're just moving along. People are aging out, and then all kinds of services happen during that period of time. So as an entrepreneur, I'm just going to go solve that problem. On the other side of it, there's also a big transfer of wealth that's going to happen, and that can be good and it can be bad, depending on how that's done.
Yeah.
Because if they keep that step up in basis, which is if they keep it in place, which it's been under attack after a while, then what that's going to do, it's going to transfer all that money to the next generation, and it's actually going to make it worse. Actually, because these a lot of times they're just not set up. They don't understand what it's like to have. It's like a lottery winner. Why does a lottery winner not have their money? Shortly after. Um, but again, if what I like to look at it, I'm just going to touch on immigration just a little bit because
Sure.
I am on the border, and there are a bunch of things that affect housing. One of them is births, obviously, and again, age one all the way to 18. The renter demographic is 24 to 35, so you have that moving through there. Then you have immigration, and you have deaths, and then But what we have right now, and we have people that are like my mom and my dad, they pay off their house and they don't want any debt. Well, so it's better for them to stay put if they physically can.
If they physically
So
can, yeah.
yeah, and because the option of moving into higher rates and higher rents and stuff like that is not a really good option. So I would say very similar that a lot of those folks are going to stay put for a long period of time until they can physically, and then they're going to move into the system where they're a little bit more managed. Um, so it just depends. Also, people are they're living longer. They're a little more active. They're a little more healthy. At least they're trying to be, I think. And so those numbers are better as well. But don't forget one other thing. A lot of those folks are also continue to have to work because inflation is crushing them. So if they're on fixed incomes or whatever, so it's a super complicated question, but it's a really, really good question.
All right. And I'm going to use it to transition to kind of, where you see opportunity right now, as an investor in real estate. It sounds like this is one of the areas where you do. Um, Real quick before we do though, you mentioned earlier that you currently hold, over 10,000 units, right? So you actually, what I love about talking to you, Kenny, is it's not like talking to an analyst who's got a bunch of models and a bunch of assumptions. Um, you're just dealing with the realities of dealing with real people, real units. Like you're right there in the thick of the mix. Um, we talked about kind of this tale of two economies, and this widening wealth gap and whatnot. What because you deal with real people who are living in your units and whatnot. What are you observing right now about how the average person is doing?
So I've been in this business for 30 years. So you can imagine we collect every month at least 10,000 rent checks, between Arizona, Oklahoma, Texas, and all the different cities. And of course, we're managing a lot of people's concerns, needs, wants, and desires, dreams, or whatever you want to call them. And I'll tell you, you know, people are struggling. They're getting second and third jobs. They're moving in with each other. Rents have gone up as a result of, in my opinion, lack of supply, and also they can't afford houses. But there's been a lot of, you're from the tech space, so I'll just tell you. So tech's all over this, and if there's Apple, there's Apple Pay. We all know what those are, but now there's Apple Pay later, which means that you can finance things. And then there's a whole bunch of businesses coming out to be able to finance that. As you know, we saw household savings go to almost to nothing, and credit card debts over a 1 trillion now. And these are big 18, 20, 22% numbers that they're paying on that debt. That's killing them. And there's a new program that just got introduced called Flex. And it's essentially, I've never seen this in my entire career. A tenant can actually pay weekly. Can you imagine that? They can actually pay their rent weekly.
Wow.
So there's a company that's called Flex that's come out, and they're what it's good for me because they basically, like, let's say you're my tenant, they pay me, and then you work it out with Flex. And so, but it we're starting to see payments, I guess, split over periods of time because it's easier for them. A lot of it, as you know, full-time employment is down and part-time employment's up, and so
Yep.
the numbers are up, but it's really because they're just getting more part-time jobs trying to make ends meet. So they aren't very good numbers, and so we have all of that going on with our tenants, and affordability is at an all-time low, unfortunately. And the last thing that we're starting to see, because I'm actually actively buying, I'm in escrow right now on a big project in Las Vegas, 357 units, and it's so we get all the data, and we're starting to see people not paying, so delinquencies. So when you start to see delinquencies, you start to see what we call skips, where they move out and they owe balances. You start to see high collections, and you start to see a rise in evictions and those kinds of things in some of these markets, which is stuff that I watch. And of course, our hands are in all. I mean, we're in Oklahoma, we're in Austin, we're in Houston, we're in San Antonio, we're in Dallas. We're all over Texas, and so these are different in each market, but the patterns are not. The people are getting squeezed, and then it's too bad. And we're trying to work with people. I actually saw this in '08. We actually, if you we people same kind of things, a little bit different, but we actually created a whole campaign around. The last thing we want is to not have you live here.
Right.
So
Push them out of their home. Yeah.
if you're going through something, let's sit down and work through it. The and so it's been it's been um it's been frustrating to watch.
And I don't mean to sound grim here, but do you expect it to get worse over the next year or two, given what you're seeing, or too early to tell at this point?
Well, for the next 2 years, I think the tenants are going to have an upper hand because of the supply that's coming that we already went over. So, whenever there's more options, I think this is good for the consumer, honestly, of anything, whether it's cars, TVs, single family houses or apartments, whenever there's an abundance of something, concert tickets, prices are lower. So you're going to see that. The issue we're going to have is in about 2 years where it's going to start going like this. Then the politicians will jump in and they'll start going rent caps, rent control,
Mhm.
landlords suck, all that kind of stuff. So, that'll all come, but really what we need is a real stable, we need we need enough supply to meet demand. That's all. If as long as you're meeting the demand, which is coming from all kinds of ways. It can come from immigration, it can come from births, they're aging out, but it can also come from people that would normally not be able to buy a home. Think of the Gen Z and the millennials, they're who needs a home when you can buy a purse, right?
Or they're buying the purse just because they've given up on ever buying a full home.
And
Um,
they can show it on TikTok. I mean,
yeah, well, yeah. How can a home compete with that, right? So, all right, I want to get into the last part here, which is about sort of, where you see the opportunity here for an investor. Let's start this part though by, again, just I want to reiterate for folks that you came to becoming a successful real estate investor by climbing the ranks, right? So you didn't come with a bunch of money and said, "Hey, I'm now going to become a real estate investor." You started off as a property manager, right? So
Yeah.
you were the guy responsible. The investors would go to and hire and say, "Look, we just bought this building or we just built this building. You're going to be in charge of actually making sure it cash flows. You're going to be the one who's going to be collecting the checks, you know, getting people in the door, getting rid of the bad tenants, finding folks to fix the issues that break in the middle of the night and all that stuff." So you really have kind of the dirty hands, kind of the micro perspective of this industry. And then as you became more successful, you realized, wow, wait a minute, I'm doing all the work for these guys who are writing the checks. Let me go get some capital. I'll be the guy who writes the checks, but I'll know the successful formula for managing these things right. How much of an advantage has your property management roots been for you?
Well, I look at it, we only manage our own stuff. So I look at it as Adam as a way to manage my own money. So as an example, we have occupancy problems, we have delinquency problems, we have leasing problems. That's actually what I deal with every single Tuesday. And so having an in-house management company to be able to solve those kinds of things, because each property is in a different location, it's got different stuff going on. And so that is property management essentially is, where was a slow week, where was a heavy week. If on a heavy week, obviously you don't focus on there, but on weeks that aren't, you do. And so when I got to the spot where I was actually buying these properties, it gave me a huge advantage because, uh, you know, it the I was taking a look at what the market was doing. I knew what the expenses were in the area. I could do really, really specific projections based on my operational background. And so, and that, as you know, is what pays everybody. Like when everybody talks about all these returns and IRRs and cash on cash, it doesn't really matter unless, the operations are sound. And so I found that this last run got kind of clogged up with all these syndicators that knew how to raise money online. And they were just buying properties almost like monopoly, but not really understanding, what was going on the inside. And that's all starting to show up now. And so that's why we didn't buy in the last 3 years, precisely because the numbers didn't work for me. And that is frustrating because I have 4,000 accredited investors that are banging on me, going, "When are you going to buy? When are you going to buy?" And I was
Uh-huh.
like, "It's not a good time to buy." And but of course we had a really good run prior to that. So, but now we're coming back in to try to, I guess, solve the problems of those that did, and and help the banks.
Okay, and I think it's a really big point to underscore here, which is you know, being familiar with your work and what you put out there on your own YouTube channel, Kenny. When you tell people to be a successful real estate investor, correct me if I've got this wrong, but you say you buy for cash flow, you hope for capital appreciation. And it sounds like way too many entrants, particularly in the last couple of years, were buying for capital appreciation. And now we'll kind of figure out how to make it cash flow once we get this thing. That accurate?
Yeah, I think, it's a people want that quick hit, it's like a flipper, buy something low and sell it quickly and make some cash and move on to the next thing. And I that moved into the commercial space. And what happened was they made major mistakes. And by the way, you got to understand, like every Tuesday I have an investment committee meeting for 90 minutes. And the analysts and my, investor committee, it's seven of us. And, they looked at 30, 40 projects before they bring me maybe 3 to 5. And so I'm looking at the 3 to 5. And so then we're making offers maybe on 1 or 2 of those. So that's kind of the numbers. And I've done that every week for the last 3 years. Well, and goose egg, right? So, okay. But I also, because I saw the numbers, saw the rent roll, saw all the stuff, I also saw what people paid. I mean, as you do, like, oh, they paid this for this project, they paid that for that project, this project went to that person, and then they go raise money. Well, what happened was they started, they started raising capital, and then the capital kept getting repriced. So the equity, like, so I was like, man, first equity is at say 5 or 6, and then is 7 or 8, and now people are paying like a lot on a preferred return for some of this equity, and I'm like, this is a game I don't want to be in.
Yeah.
And because what people don't remember is that what pays everyone back is the property. So the property has to perform. So they made mistakes on the buy, and then they made mistakes on the equity. The debt was the debt that was, pretty locked and loaded, but the property management, the purchase, the property management, and the cost of equity is what killed everybody. And so that all just, that's what just kind of made it through. And, irrational exuberance. That's all it was.
Okay, which it sounds like you see is getting kind of squeezed out of the market now. So you mentioned that after a long hiatus, you're starting to buy now. You mentioned earlier that part of what you're looking at is some of these more, senior living and care related opportunities. Where else do you see opportunity right now in this market?
Yeah,
And,
there's a
and do you
lot.
plan to be buying increasingly over the next
Yeah.
couple of years as things trough?
Yep. So I always go back to the math, always. So to your point, cash flow over capital gain. So I always start there. So if I'm gonna raise money from somebody, I want to make sure that the property covers it in year one, period. Right. So whatever the cost of the equity is, the property has to pay that. At least, right? Otherwise, you're just banking on it to go up. So that's actually so that's the first thing. There's a bunch of opportunities as things move. The big kind of elephant in the room are the failing office buildings from the work from home. People are not going back to work like they were. And so occupancies, I mean, San Francisco is probably the poster child of that.
Mhm.
Last I heard, I talked to a commercial broker and leasing company out of San Francisco, and they were saying that a lot of buildings are 50, 40, 60% vacant. And so, so you start to look at that. There's somebody that owns that. There's debt and there's equity, or there was equity, I should say. So there's a beautiful big project sitting there. It could be one story, 2 story, it could be 100 story. There's a story behind it, and there's a way to buy those. And so we're starting to see those getting repurposed. I heard a story just least recently where, a buddy of mine bought one for $1. And I said, I asked him, I go, was that a good deal? He goes, I don't know. I mean, imagine, because now you step into the liability of all these things, the property
Yep.
taxes, all stuff, and it's vacant, and, now you're feeding it to try to turn it around. But there's a tremendous opportunity there, from office to residential, even though that's really hard, from office to self-storage, office to retail. So there's going to be this big repurpose on the office building side. And that's going to last a long time. That's one. The Amazon effect is really annihilating a lot of retail. So, think of Macy's, think of Sears, think of regional malls. Those are massive redevelopment opportunities that are happening already. The senior housing, as we pointed out earlier, the seniors are getting older, and so you just solve that problem. They're at some point these people are going to need some kind of a care. And you could do assisted, you could do independent. There's all kinds of variations from that. And then on the long term, which is kind of what we're doing, is we see an opportunity right now to buy below replacement cost. So think of the contractor that was building a 200 or 300 unit project, and they have a construction loan right now that's sitting at 8 or 9%, and the property's done, and they're having problems leasing up. Let's say those are great opportunities for us because we'll go in and we'll take care of the construction loan, which is a personal guarantee for that person, and we'll put regular agency debt on like Fannie or Freddie. And then I just have the property management or the lease up problem. So kind of back to my roots, I feel very comfortable with being able to fill up a project, fix a project, and stabilize a project. And a lot of times these owners and builders don't know how. So you've got just a whole bunch of incredible opportunities. Obviously, last mile distribution is hotter than hot. Probably not a good time to get into it, but everybody wants their Amazon stuff today. When they order it, they want they order at 1 and they want it at 5. Well, that's only possible if they have a warehouse nearby. So the commercial industrial is just on fire right now, and so is cold storage. And then, gosh, I can go on and on. Cloud-based stuff is on fire. Cell towers are on fire. There's the real estate market is it's fascinating. There's just so many things that are going to be just going like this over the long period of time. I'm in the process of buying billboards. I own a bunch already, and those are no people the cash flow. So so there's just like nobody wants billboards, and and people are off their phones when they're driving. So they're like, oh. It's like it's oddly enough, who would have thought? But billboards are actually making a run right now.
They're on the rise. Well, Kenny, look, we're approaching the end of the hour here, and you're kind of peeling back the curtain here just to show how varied the opportunity set is in real estate, and how interesting it is. Even though parts of it are getting clobbered, like the commercial real estate side you were talking about. So let me just put you on the spot here and say, if there's enough interest in the audience here for maybe have you come back on, maybe we'll do like a special webinar where it's less me asking questions of you and more the audience asking questions about a lot of these different opportunities sets.
Oh, that'd be fun.
Would you be up for that?
I actually love that. Yeah, it's it's all I do all day. So for me to be able to answer questions, plus I always learn. Like I always get this one question that's like, that is a great insight on something. So I love that stuff.
Awesome. All right. Well, look, folks, if there's interest in that, please let us know in the comment section below. And if interest is high enough, I'll go back to Kenny and twist his arm to see if he can come on and do that. I think that'd be a lot of fun. All right. Let's see here. Just in wrapping up, ton of questions I didn't get to. Maybe we can get to them in that webinar if we do it. Let me ask you one last question before we wrap it up, which is one of the advantages of real estate as an asset class is there's all sorts of tax advantages that can come along with it. How critical are those to the success of your operation and your approach?
They're very. I mean, at the end of the day, we all are trying to work as hard as we can and make as much as we can. And what I didn't know as a young man that I know now is that there's a lot of ways legally to actually put yourself in a position to be able to take advantage of tax, credits and tax savings on things that you do. And so all I'm trying to do, Adam, obviously I'm working hard, but if I can figure out ways to keep more legally, the thing about the tax code is it's basically a whole book on stuff you can't do, but there's a little piece in there that actually tells you what you can do. And that's actually, whether it's alternative fuels or solar or right now ESG, all that stuff is like on fire. Affordable housing's in there. That there's a reason why the government is in the housing business. They actually want people like myself to actually provide it, and they give huge tax breaks. So I didn't start off by, this wasn't the path that I started on, but now that I've learned it, it is an incredible way to offset tax illegally by investing in spots that the government wants you to go into.
All right. I think in that workshop, we'll probably get a lot of questions specifically about what parts of the tax code you tend to leverage most often in your
Yep.
projects. All right, with that, Kenny, it's just been so great to spend time with you again. Thanks for coming on. It's been a fascinating discussion. For folks that have really enjoyed this, maybe this is their first exposure to you, where can they go to follow you in your work?
Yeah, KenMcElroy.com is kind of the best spot to go. Our company is MC Companies, IES.com, and those are the two avenues. And obviously, we got the YouTube and podcasts and all that kind of stuff. But you can find all that on the KenMcElroy.com.
Okay. When I edit this, Kenny, I will put up the URL to your website there on the screen so folks know exactly where to go. Folks, I'll have a link to that plus Kenny's other resources he just mentioned in the description below this video too. All right, Kenny, got one last question for you. I'll give you about 30 seconds to think of your answer to it while I do a little housekeeping. But the question is going to be, what's a big important lesson that you've learned along the arc of your career here that you think is worth sharing with the audience? Folks, if you've really enjoyed this conversation with Kenny, would like to thank him for coming on, but also show your support for him coming back on for that webinar I talked about. Please do so by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. And just a reminder, for most people, the real estate transactions they do are some of the biggest financial decisions they make in their lives. If you'd like some help thinking through any of the real estate decisions that you're trying to make, consider scheduling. I think you should definitely go tap the expertise of a good professional financial advisor. If you've got a good one who can do that for you, great. But if you don't, consider scheduling a free consultation with one of the ones that Thoughtful Money endorses. To do that, just go to thoughtfulmoney.com. Only takes a couple of seconds to fill out the form there. And if you're there at thoughtfulmoney.com, that's also where you can sign up for our free newsletter. All right, Kenny, we're back at your last question here. What's one big lesson you think is worth sharing with the audience here that you've learned along the course of your very successful career?
I think probably the biggest one for me was how much Wall Street wants my money. So no, I mean that like I was like, okay, so like when I put a bunch of money into the bank, like it's a liability for the bank. It's expense to them. So they want it, they want to put it out to somebody else. And then
Mhm.
same thing with life insurance, same thing with pensions, same thing with, all of these products, these products, they all want it. They all want your hard-earned money. And then they incentivize the employers to do matches and all this kind of stuff. But all that money eventually makes it to people like me. I mean, that's the money I use to buy stuff is managed money. And I didn't realize as a young man how that circle works. And right now, as we talked about earlier, um, they're going after the single family houses now. So, they've always done it, but now Wall Street is coming after Main Street, right smack at this single family housing. It's going to be an interesting time to watch. I can tell you one thing I learned. It's never going to stop. So you have to figure out a way to be outside of that system and participate in it because you're not going to stop it.
Wow. All right. That both sounds very important lesson, and also kind of a scary, somewhat depressing one.
Yeah.
But I appreciate you putting it front and center on folks' radar. And again, you're a guy who's in many ways, a beneficiary of that, where they're taking that money and they're giving it to you because they can earn, their fee in that process.
Well, I went to a meeting once, Adam, and this just cracked me up. And this is early on when I was trying to figure all this out. And it was a meeting with a bunch of big private money, and it was all insurance companies, and they were big names. And I won't throw any of them under the bus here, but they're all like, what do you need? 100 million, 200 million, 300 million. These are all like insurance companies and pensions. They're investing in all kinds of stuff, and one sector, of course, is real estate. So the money gets collected by Main Street, and then it just gets managed by Wall Street, and it gets put right back out because they don't know what to do. They have to find guys like me.
Well, to your point, they don't make money on dead money, if you will, if it's just sitting there. They only
Yep.
make money if it gets put into something. Whether
Yep.
and then we can argue whether that's in the account holder's best interest or not, but Wall Street doesn't necessarily care because they
Oh,
want to feed themselves.
right. So that was probably the biggest thing for me is you know, when the bank has lots of deposits, that's a problem for the bank.
Yep. All right, my friend. Thank you so much for coming on. Thanks for giving such a great discussion, Kenny. It's just it's always such a pleasure to get
Yeah.
to reconnect with you. Thank you for everything, and look forward to having you back on
Yeah.
soon.
Thanks for being on, Adam. I appreciate it. Good seeing you too, and looking forward to the webinar.
All right, buddy. Thanks so much.
See you,
Everybody
man.
else, thanks so much for watching.